Welcome back to Real Estate Economics weekly webinar series. This is part 2 of 3 for the Las Vegas area, October 2010. In the previous section, we looked at some of the historical trends in terms of resale volume, subdivision sales, foreclosure sales, and distressed inventory overall. Let's take a quick look at employment here. This area had a fabulous employment track record, really going back to the middle of the past decade. Beginning about 1995, the employment grew very quickly here, more than 5% on a compounded annual basis all the way through 2005. This area really shrugged off the national recession in the 1993-94 period that was associated with defense spending. It really fought through the dot-com bubble and really continued to grow in the 2006 and 2007 period. So it was no wonder people felt positive about the economy here. It seemed to be the Teflon economy and wasn't really taking too many hits. We can see there were some dislocations in unemployment rates in just a moment, but overall this area performed quite well. Interest rates were low, and there tended to be an era where conventions were popular, business excursions were popular, that sort of thing. We're all very supportive of this gaming, leisure, hospitality-based economy. Here's the data presented on a 12-month change basis. You can see this market from the mid-90s was picking up 30, 40, 50,000 jobs per year, almost 60,000 in 2005. Now in the 08, 09, 2010 era, we're going to lose about 120 and gradually, and I mean gradually, start to pick those up in the 5-year forecast. Those numbers seem like they're fairly robust in the forecast period, but we're going to need each and every one of those to help unemployment in this particular area. You can see in this table these are annual figures, average annual figures. So we know current unemployment rates are higher in the city of Las Vegas. Presently, I believe the unemployment rate is 14.8%, and Nevada as the state has the highest unemployment nationally, and many of the cities within the state are also high, with Las Vegas being higher than the other MSAs. Some of the national recession you can see in the unemployment rate here. 92, 93, 94 had a little run up. The dot-com period in 01, 02, 03 had a little bit of run up, but really it wasn't until the credit contraction and the current subprime fallout really took hold that we had tremendously high levels of unemployment in this particular market area. Let's look at building permits going back to 1990. This was a market area that ran around 30,000 permits, 25 to 30,000 sustained from about 94 to about 2007. Initially, much of it was single family and apartment, but we also had a vibrant condo component, maybe too vibrant, in a few years when the high-rises started coming to town. You can see at present, in 08, 09, and through the forecast period, permits are very depressed. That will gradually help us return to equilibrium in terms of the size of the housing stock compared to the size of the employment base. We like to look at population growth in almost every area because it can tell us quite a bit about buyer profile, who's coming, who's leaving, what parts of the market will be healthy. This area had a very healthy profile historically. You can see there is considerable growth amongst kids. The 5 to 14 looks real good. 15 to 24 looks very good. What we'd like to talk to in the mature age group, the 45 to 54 and 55 to 64. 55 to 64, we've had about 130,000 growth in the 2000 census, growing to almost 250 in the 2015 forecast. So this area is capable of drawing tremendous numbers of mature buyers. A part of that is income tax. If you leave California and sell your high equity home on the coast and come to Nevada, you can immediately forego a 9.3% state income tax rate that's probably just going to climb given California's state budget problems. That will practically pay for a home at some income levels in some parts of this particular market. So It's an area that has a lot of single-story homes. It's an area that has had a vibrant, active adult market, and we think that continues. Mature buyers tend to be very discretionary and sensitive to news, so we're not really seeing that demand in huge numbers now, although many people we hear anecdotally are moving to this market really to take advantage of the tremendous values that are offered in the housing market here. There are some budget dislocations here, so service levels are a concern, and that's mature buyers are an age group that will increasingly be considering the state's fiscal conditions and service levels before they purchase. Let's quickly go to national fixed rate mortgages. You can see here we've been in a very long-term declining trend in both interest rates, U.S. government treasuries, government bonds, and U.S. domestic mortgage interest rates. This goes back, probably about 30 years, and really typically will not change without some volatility, without some disruptions, without making a lot of noise, if you will. So if we're going to have a complete change in the direction of interest rates, the bottom might not be perfectly signaled, but a change in trends should be well signaled to almost everyone paying attention. If you look at the 2008 time period, rates averaged about 6%. Remember, these are on an annual basis, going down to 5% in 2009. That's when the government began their extraordinary interventions into the mortgage market, helping to support the banks and the housing market. For 2010, we've got a 4.7 annual rate. We've seen that actually come down through the course of the year. I think the 30-year mortgage in the past 2 weeks has hit its all-time low. I'd say there's probably chances it'll go lower. It has not drawn that many buyers, but it's been great for refinancers. And if you can see over the forecast period, we're forecasting somewhat higher rates as we go out 5 years. This will essentially act to keep a lid on home price appreciation. We'll be able to see that in this graph and some of the other subsequent graphs here today. This is our housing demand and supply analysis. The blue line is the supply of housing. Almost any market you go to, supply grows fairly slowly. It's difficult to buy land and acquire land at the right price and get the approvals and get the construction financing and undertake all the steps that it takes to build a subdivision. So almost to a T, some areas are worse than others, but nationally it is a fairly slow growing line. The housing supply just doesn't really grow that fast. Even on good economic times, it takes years to ratchet it up, and in bad economic times, it takes years to overcome the slump. But it's the demand for housing that oscillates tremendously. When the economy heats up, demand manifests itself very quickly and can rise up above supply, and that just leads to price increases. The only way for that excess demand to manifest itself is through higher prices. That's usually not a big problem, except in times where we have subprime and that sort of dislocation between what people can afford and what the market will allow them to buy. If you look in this particular table and graph, you can see that the demand for housing came off tremendously in 08, 09, 010. That's due to job losses. Essentially what's happened here is the losses in employment have made the employment base too small for the housing stock, and that leads to value declines, and it has also led to a certain degree of undervaluation, which we'll talk to. Here you can see the over and under supply measured numerically. When the economy was very hot in 2005, 2006, 2007, this market became more than 80,000 units underbuilt. That's on a straight comparison of housing inventory, housing stock, if you will, to employment. Now, look how quickly, when the employment unraveled, look how quickly this market became tremendously overbuilt. Now, we just talked to supply levels growing very slowly, so that tells us without a doubt that these relationships are primarily driven by employment. So it's our loss in employment that's caused the tremendous problems we're suffering through right now. We present this housing valuation graph in all of our residential economic reports across the nation. This is probably the most severe one that we ever see. Where this blue line, that's the historical median home price, spikes way up. That's the subprime era, when people could acquire a far larger mortgage than they could pay back or support. When they get that expensive mortgage, that drives prices up far beyond reality. If you recall, in section 1, we were talking about home prices being in the upper 300,000 range, with the equilibrium home price being still under 200,000. That causes that tremendous bubble. Now we're in the payback period as you come towards 2009, 2010 in the forecast period. All that excess appreciation, excess demand, that bubble demand has been forced out of the market, and homes have become tremendously undervalued. That gap between the supportable median home price and the forecast price is the extent of the undervaluation, which is quite huge. I want to just point out on the green line, if you see that from the dots that represent the forecast period, that's going down over the next 5 years. That's attributable to interest rates, which are going to make home prices more affordable even if values stay the same. So that's the part where we keep a lid on our price appreciation. You can see that measured again here. Homes become tremendously overvalued when there was subprime lending available and the economy was creating quite a few jobs, and then when the employment picture changed, we reverted very quickly over just a couple of years from tremendously overvalued to tremendously undervalued. Now we've got several years essentially of payback before we get back towards equilibrium at the outside of the forecast period in 2015 essentially. Now other markets regionally, we're going to be seeing equilibrium returning much sooner than that. It's just the severity of the damage here is going to take a couple of more years, and if you look at it, we've really got 12 or 13 years in a full cycle from equilibrium to overvaluation to undervaluation and back to equilibrium. So we're talking very long time frames and very deep and protracted dislocations here. Let's look at the home prices. You can see the bubble that we just saw in one of the previous graphs about housing valuation, how values raced up very quickly from the mid-100s all the way up and over 300 on a median basis, and now coming back down. Look at where the 2010 prices lie on the red line. You can just see the red line peaking above the 2010 price at 139,819, again on a median basis. That takes us all the way back to the year 2000. So we've undone a 10-year cycle of bubble and payback has come all the way to home to roost, and we've got a little bit of appreciation over the next 5-year forecast. Here's how it presents itself on an annual basis. We saw, CPI levels of appreciation here from the early 90s all the way through the early 2000s. Then we got this huge spike up. I don't have empirical evidence of this, but we had the dot-com bubble in 2001, 2002, 2003. This market was showing high levels of appreciation, 8 to 14%. There's quite a bit of business and travel and other things taking place that were supporting employment in this market, and I think some of that translated directly through to house price appreciation, really in advance of the subprime era. Then once subprime took hold, we had these huge, 70% increase over 3 or 4 years, and now we've given 60% of that back. We've got some price improvement in the forecast period that's really going to be unwinding the tremendous undervaluation that we're experiencing now as the economy adjusts to the new reality, as the economy finds its feet again and people's confidence build. They'll eventually pick up some homes, but these numbers are very low given the amount of price degradation that we've suffered in the past 3 or 4 years. That's the end of part 2 out of 3 today, so please join us for part 3.